Hello and welcome to this edition of LNG Watch, our monthly video series delivering insights and analysis into the global LNG market. I'm Stephanie Wilson, Managing Editor for Asia LNG, reporting from London. In this episode, we're going to take a look at the recent fall in crude values and what it could mean for the LNG market going forward. Let's start by taking a quick refresh of the spot market movements in the last couple of weeks. JKM has seen one of its most volatile periods in the history of the market over the past few months as crude prices tumbled and low demand continued to weigh on the market. As you can see, the JKM for January delivery to Asia plunged 46.9% year-on-year to average $10.06 per million British thermal units, or MMBTU. This reflects the largest reduction on year since Platts began assessing the market in February 2009. The market also reached single digits for the first time since the week of the Fukushima disaster, as demand for spot cargoes has remained limited owing to mild temperatures in Northeast Asia. Meanwhile, ample supply from various projects in Asia Pacific has more or less covered demand. In the past few weeks, we've seen prices beginning to level off, but the outlook for Q1 suggests that low crude prices will likely add further downward pressure. We see that the Japan's customs cleared crude price, which is the average price of customs cleared crude oil imports into Japan, priced 3 months retroactively, is still quoting for September around $100 a barrel, while October is estimated to close only slightly lower. The majority of Asian LNG term contracts are indexed to JCC. With prices around $100 a barrel, this gives a term price of around $16 when using a standard 14% link plus 40 cents alpha. The 3-month lag on JCC pricing means we won't actually see the recent fall-off in Brent crude values, which were hovering around $62 a barrel on Asian close today, Monday the 22nd of December, reflected in the JCC import prices until March at the very earliest. Earlier this year, we saw LNG term buyers exercising their options to lower the term deliveries in Q1 2015, opting instead for spot, which they perceive would be lower in price as a result. The downtrend might even be more protracted over LNG term contracts, as a number of LNG buyers' term contracts actually have a lag to JCC, suggesting that they won't see the benefits of lower crude prices below $100 a barrel for 6 or even 9 months, meaning the pressure on term prices will be there till at least mid-2015. Brent prices around $60 a barrel give an LNG term price around $8.50 per MMBTU when calculated on a traditional 14% slope. At this price, we could see more appetite from the traditionally price-sensitive customers in India and China. However, if sellers are to offer spot, they will probably have to offer fairly keen prices, at least $1 per MMBTU below the long-term price, given the current demand and supply balance, in order to tempt buyers away from the security of term contracts into the spot market. Fueling the downward pressure next year will also be additional volumes from Australia. This year we saw the effects of incremental production from Australia and the Papua New Guinea startup, which collectively added more than 3 million metric tons per year to the market. In 2015, we will see BG's 8.5 million tons per year QCLNG project, Conoco's 9 million metric ton APLNG project come on stream, and the Santos-led 7.8 million metric tons per year Gladstone project will also be online by 2015, and this project has reportedly already tendered as many as 13 cargoes out ahead of its startup in Q2. Collectively, the 3 projects will have more than 1 million metric tons per annum, which has not been placed under term contracts, according to Platts calculations. Between 2015 and 2017, we will also see the addition of the 8.9 million tonne per year Wheatstone and 15.6 million tonnes per year Gorgon projects, which could add more than 5 million metric tonnes per year of uncontracted supply to the market. In addition, new supplies from the US will also be on stream by the end of 2015, a proportion of which will also likely make their way into the short-term and spot markets. It actually remains to be seen how competitive the Henry Hub link prices will now be in a climate of falling crude values, but the estimated landed price into Japan of $10 or $11 per MMBTU based on a $4 MMBTU Henry Hub price, $3 tolling price and $3 per MMBTU shipping price already begins to look somewhat unattractive for buyers. As yet, we haven't seen a reversal in the trend among Asian buyers who are looking to diversify away from indexation from crude, despite the lower prices, but this could become more apparent over the next year should lower crude values look to be a sustained trend. However, with more spot volumes could come lower spot prices. Arguably, this is the rationale behind the landmark deal between Japan's second largest LNG buyer, Chubu Electric Power Company, and France-based GDF Suez. The two have recently concluded a deal for 20 cargoes, or 1.2 million metric tons, delivered over the January 2014 to March 2016 period, with a confirmed indexation to JKM, which is widely regarded to be around 10% of the total contract term. There is an intention to hedge these positions on the LNG derivatives market. More recently, Chubu has also joined forces with TEPCO, Japan's single largest buyer of LNG, to launch a joint procurement tender for 6 cargoes for delivery between April 2015 and March 2016. Bids for the tender are still valid until January the 9th, and a source close to the deal said that the utilities would accept bids on either an FOB or DES basis, with different pricing elements slated such as the JKM, Brent, JCC or NBP. That's all for this edition of LNG Watch. On behalf of the LNG team here at Platts, I'd like to wish you happy holidays and a happy new year. Please join us again in January 2015 for more market insights.